Okay, welcome everybody. Welcome to another Homebuyer workshop. My name is Michael.cadet, and thank you so much for joining me today. We're going to probably spend about 45 to maybe an hour going over this information. We're going to go ahead and give you all the tools that you're going to need in order to buy your first home. But before I do dive in, I do want to just take a quick moment and just to tell you as to why we are doing this workshop. Okay, so the reason why we're doing this workshop is because this is one of the biggest and most important financial decisions that you're most likely going to make in your financial life, right? It's going to be one of the biggest assets that you acquire through your lifetime. Okay, and so, but for so many people, first-time home buyers, even people who are, going through a transition into a new home, can feel sometimes just overwhelmed with the whole process. They can feel confused with all the moving parts that's included in the whole process. And this is the point that we're here. This is the reason why we're here, is that I'm going to break down everything that you need to know in order to remove any confusion and give you the confidence and empower you to be able to make the right moves to purchase a home. Whether that's going to be your first home or if that's going to be your second home, this is going to give you all the tools that you need. Okay, so a little bit about me. I was raised in Marin County, California, raised by a single parent, beautiful Haitian mother, and she put me through college all by herself, and she taught me, about hard work, about resilience, integrity, and she taught me also about service. And this is the reason, or really the heartbeat behind like what I do and why I do what I do. It's not just about doing loans and interest rates and things like that. It's really about helping people at the end of the day. It's about helping people get into their home, get access to generational wealth, and start building wealth for them and their family. So this is really the heartbeat behind what I do, and all of these things is what I picked up and were instilled for me from my mom. But that is that. So let's go ahead and get started into this thing. So we talked about why we're doing this, right? We're here to give you the tools that you need and give you the confidence that you need in order to take that first step to purchase a home, to acquire that the biggest asset that you're most likely going to deal with in your lifetime. Okay, but this is what we're going to go over today. We're going to pretty much be going over the basics of renting versus owning, the benefits of buying. We're going to assess your financial situation and then put together a home buying game plan. We're also going to do like a mental and an emotional check, because the mindset is really important when it comes to just going on this home buying journey. And then we want to give you the mindset of how the bank looks at you financially. So we'll take a look at how that works, and then we'll give you a straight and direct home buyer roadmap straight into home ownership. And then of course we'll open it up for questions and answers. Okay, so renting versus buying. I'll always start with renting versus buying because obviously this is where a lot of people start, and this is where I meet a lot of people, is that they come to me from a financial situation of renting, and so they typically want to figure out, how can I take that leap from renting to ownership? And typically what's stopping them is fear. It's just the fear of just not knowing how to navigate this whole process. Okay, and this is what we're going to walk away with. We're going to walk away with that confidence to eliminate all that fear. Okay, but let's understand a little bit about what are some of the benefits between owning versus renting. Okay, because a lot of folks are currently in a situation where they're currently renting. So what is happening right now? Because I talk to people who rent all the time, and the hesitation to move forward in most cases is due to just a lack of information and just understanding what's happening to them financially currently. And so what's happening currently, when you are renting, here's the impact financially that's happening. Is that, so let's just take, for example, the average rents in California. Okay, now California is out of kind of the ordinary because we live in a high cost state, one of the highest, real estate values in the nation. But since we all live in California, we're going to take California as an example. And average rent in California is going to be about $2,700 as of 2025 in January, according to Zillow. Average rent in California is $2,757. Okay, so in just 1 year, as a renter, you're going to be shelling out about $33,000 just in 1 year as a renter. Okay, so $33,000 is going out the window. In 2 years, that's $66,000, $168. Year three, I mean, you get the point. It just keeps on getting worse. Year three, it's about $100,000. Okay, so the difference is that when you're owning a home, there's some financial benefits that come along with owning the home. Okay, there's really three main tenets of in terms of benefits that come along with owning a home versus renting, right? So I just explained the money that's going out, right, every single year as a renter. Now, as a owner, the benefit is, for one, you have a tax benefit. Okay, so the tax benefit is every single year, every single month, essentially, when you pay your mortgage, you make it, principal and an interest payment. So at the end of the year, you're going to get a form called the 1098 interest form. Okay, and the 1098 form is going to show you essentially how much mortgage interest that you paid for the year. Okay, so when you get that interest statement, you're going to take that to your CPA, and then you're going to use that to reduce your taxable income. So for example, if you're making $100,000 a year, paying taxes on $100,000 income. When you own a home and you're paying interest, let's say you paid $20,000 worth of interest. Well, instead of paying taxes on $100,000, now because you paid interest for the year of $20,000, you get to reduce your taxable interest by $20,000. So now instead of paying taxes on $100,000, you're paying taxes only on $80,000. Okay. The other benefit is that you get to build equity. So every single month, when you make a monthly payment to that home, you're going to not only build equity because you're reducing the balance of the loan. So every month when you reduce the balance of the loan, that creates a little bit more of equity into the home. Okay, and then also you have the other factor of appreciation. Now, appreciation is more of a gift. It's not a guarantee because just like any market, you have your peaks and your valleys, but that is another benefit I would say that is more of a gift. So you have three benefits working for you. You have the tax benefits, you have the equity, building mechanism, and then you also have the appreciation of the asset. Okay, you don't get that with renting, right? And so that's where we typically have to start, is just to have a realization as to what is happening financially every single month when we are renting. Now, granted, for renting, we have a place of shelter. We have a place that we can call home. And that's fine. That's what we all need. We all need shelter. We all need a place to live. But it's also important just to be able to be aware of what's happening financially. And that's what's happening. But these are some of the benefits that you can realize, that if we can take that first step, just to at least be aware and understand what it takes to become a homeowner, then we can eliminate that financial situation. The other benefit too is pride. Being a homeowner comes with an immense level of pride and ownership. I mean, this is going to be a place that you're going to create memories. You're going to build your life in. You're going to have a family within. So you're going to come. It's going to come with an immense level of pride. Just being a homeowner. So these are other benefits that just come along with being a homeowner. And then just the fact that it's just yours. You get to do whatever you like with it. If you want to make an addition to the deck, you want to add a new wing to the house or something like that, it's yours. So I mean, you have that freedom to kind of do what you like with that home, versus if you're renting. Okay, so those are some of the benefits of owning. So let's get an assessment essentially of what is the mindset and what our mindset is going to need to be in order to take this journey. Okay, because this is a whole journey. Some people, when I first meet people to come purchase a home, some people are ready to go, next month. They're ready. Hey, I got all of my documentation. I got all of my income. I am ready to go. Let's get going. Some people, it takes a little bit longer. It takes about a year, maybe even two. Maybe they need to get some things in order. They need to pay off some debts or whatever the case is. But the mindset that's necessary is a mindset that is of resilience. You need to have a resilient mindset. Okay. And so a good way to help kind of construct this mindset as we embark on this journey is to ask why. Like, what is the why? Why are we even doing this? And this is the typical question I ask anyone that I first meet is, so why are you even thinking about moving? What's the motivation here? What's prompting you to even think about taking this journey? And you'll be surprised to just kind of find what that answer is. And it may be very simple. It may be simple like, hey, my why is because I got a new job and I just need to buy a house. Or, my why is I'm expecting a new child and, we just cannot raise a family in this, 800 square foot home. We need a bigger house. So establishing that why is going to help you move forward in the face of any difficulty, in the face of any obstacles. Establishing that why very firmly in your mind is just going to help you push through. Because it's not always going to be, smooth and easy sails to to that path and goal of home ownership. And just being able to keep that why very clear and just intact is going to help you navigate through any type of difficulties. Okay. Also, asking the question why is, also should pop up some other, answers and things to think about financially as you're moving forward with this. So, if you're thinking about purchasing, with a partner, last month we did a workshop about buying real estate with your partner. So these are conversations that you really want to have with your partner as to what is going to be your partner's needs. Do they need to commute, a lot farther versus, where you need to commute in order to go to work? Is this going to be something that you're willing to commit to in terms of the home, the commute? If you have children, all of these things is like, it's a big, on-taking to take into consideration as to, why I'm doing this, because it's all going to make it worthwhile when or if, difficulties arise. And difficulties in terms of what I mean in difficulties is, right now the main challenge in the real estate market is the lack of inventory, right? Or even if you do find the home that you do like, it's a matter of now, can I get the home? I'm going to have to compete, because if it's a home that's desirable, most likely other people are going to want the home. So I got to have that mindset to say, hey, if I don't get that home, do I still want to move forward? Is my why strong enough to want to still purchase a home for myself and my family? Okay, so asking those questions, very important, because the mindset through the whole home ownership journey, I believe, is very, very important. Okay, so so this is the part where I want to just kind of quickly go over how a bank thinks in terms of how they're looking at a borrower. Okay, so this is what a bank is pretty much looking at. They're looking at your credit, and again, I would say more like this is more of a mindset that you would want to adopt as a just a financial participant, in the world. This is pretty much how you want to think and behave financially, right? Because these are the tenets within your financial, portfolio, which is your credit, your monthly survival number, which I'll talk about, the cash that you have, your income, and then your debt to income ratio. Okay, so that is your financial life right there. Your credit, monthly survival number, cash, income, debt to income ratio. So your credit, obviously the higher the credit score, you're going to be able to qualify and have access to just more products, better terms, better interest rates, things of that nature. The monthly survival number is a number that I always challenge folks to calculate for themselves. And essentially, what that is all you have to do is just go home and write down all of your monthly expenses. Okay, write down all of your monthly expenses and then just times that by 6 and then times that by 12. Right, and that should be a goal for you to save. That should be the first like savings goal, right? Because that will give you 6 to 12 months worth of expenses. So in the event that anything goes awry, or if you have an emergency or something like that, or if you lose your job or something, you have 6 to 12 months worth of expenses tucked away just for an emergency, and you don't even need to touch that money. That should just be there just for for emergency purposes. Also, it also gets you into the habit of paying a mortgage, right? Because if you have that extra savings, it's almost like you're paying a mortgage, because every single month it is like kind of like a forced savings account when you do pay a mortgage, because every single month, like I mentioned before, that principal payment is building equity for you, right? Cash, like I just mentioned, 6 to 12 months of your monthly survival number, your income. Of course, we want to make sure that we have consistent income, because the bank, they're going to be looking at typically between 2 years of income history. And then your debt to income ratio, which is the ratio between your monthly debts versus your monthly income. Okay, so that's how a bank is typically looking at you, right? They're looking at all of this stuff, and in terms of like your monthly survival number, that's how the bank is, in their eyes, they're like, how much assets does this person have to survive, for the next, 12 to 6 months. Okay, so that's what a bank is looking at. Now, understanding what makes up a credit score. All right, so the biggest factor that makes up a credit score, I'll just go right to it, is your payment history. Okay, so the payment history has the biggest weight. Okay, so typically when we're qualifying folks to purchase a home, you need a minimum credit score of at least a 580. I can get someone a loan with a 580 credit score, but that's for FHA financing. Different terms apply for that, but 620 will get you conventional financing. So what impacts your credit score the most is going to be your payment history. Okay, so that impacts it about 35%. So things like missed payments, that they really hurt your score a lot. On-time payments definitely build a lot of trust, with lenders. Even one missed payment can equal up to about 7 years being reported on your credit report. So, try not to miss any, monthly payments on there. I say, like, even if you're like running a little behind on your budget, I would say at least just don't make a 30-day late payment. If you have to like incur like late fees, like you paid it like on the 15th or something like that, late fee, I would rather you do that versus missing like the full 30 days. Because once it hits 30 days, that's when it gets actually reported to the credit bureaus. Okay, the credit utilization, that's the other part that has a lot of weight. So the accounts, or excuse me, the amount owed. So for example, if you have a $1,000 credit card, like with $1,000 limit, and you have you have like a $900 balance on that card, well, you have a 90% utilization rate, and the bank is like, no, that's not good. They're gonna say like that is too much. You are highly leveraged right now, and that is posing a risk. So they typically want to see you at a 30% total utilization rate. So in that same example I just gave, if you have a $1,000 credit limit, you want to keep your credit balance at $300 or below. That would be optimal, but I mean, if you really need to, of course, use the credit, I mean, don't try to get it all the way up that high. Try to seek other means to, finance whatever you need to finance. But again, we're just explaining how the bank is going to take a look at your financial situation. So try to keep it at 30%, because as you can see, the higher the utilization, it has a big impact on your credit score. But the length of credit history does matter because the bank wants to see that you have some type of trade lines established, so some type of credit established essentially. So I'm dealing with someone like this right now where they're young, they're about 21 years old, and they just never had any credit, and but they just financed a car, and they were like, well, like I don't have any bad credit, so how can I get qualified, and when I ran his credit, he didn't have a credit score. So for situations like that, we have means to still essentially create a credit score for you, which is called a non-traditional credit program. And so through the non-traditional credit program, pretty much what we would need to document is like that you've made on-time payments with a phone company or like your utility bill and things like that, and then submit that to the credit bureaus in order to build a credit score for you. So all hope is not lost if you don't have a credit score or if you don't have a trade line. There's still creative ways that we can still build a credit score for you. But of course, that's just case by case scenario. The other two, new credit types of credit used. Like if you're getting credit cards from like Macy's and like retailers and things like that, that it's not going to have a big positive impact on your credit situation, but it does have a slight impact. So if you're shopping for like a mortgage or portfolio lines of credit, things like that, these are considered good debts. So that those two items, they don't really have that much weight, but still something to consider. So just a quick guide in terms of like what the bank is looking at in terms of your credit scores, like what you can qualify for each range and score. So the highest score you can get where there's like really no like extra benefit is a 740. So I mean, once you're at a 740, there is really no extra benefit. You're going to get prime pricing. You're going to get the best terms out there. Pretty much it's it's your world at that point. If you have a 740 plus, you're all good. So I know people come to me, they're like, hey, I got an 800. Like, do I get some extra, points for that? Like, not really. Cut off as that 740. Between 680 and 740, you'll still be able to qualify for mostly all programs. Honestly, like you'll be able to qualify for all programs. Maybe a slight hit on pricing, maybe depending on where you're at and other factors. But 680, 740 is a really good sweet spot. It's where I find a lot of people at. 640 to 680 is also a good sweet spot. You'll still be able to qualify for down payment assistance programs. You'll qualify for conventional FHA, all that stuff, and still be able to get good pricing and good terms, within that range. Once you start getting below 640 is where the pricing on interest rates, your terms and things like that start to get impacted a little bit. So that's where you now don't really qualify for down payment assistance programs. The cutoff is at 640 and above for down payment assistance programs. So below there, you can still qualify. However, it's just the pricing on the interest rate. Your interest rate is going to get hit pretty hard once your credit score is below that 640. Okay. So just a quick cadet tip is 1 in 5 Americans find errors on their credit report. And credit report mistakes, they can lead to disqualification. So it is very important to monitor on your own your credit score, as this could influence your ability to get a loan. So every time that I pull someone's credit report, first thing that I do is I just scan through the whole report just to make sure everything that's on the application is matching what's on the credit report. So things like the social, birth date, any debts that they've listed or gave to me, addresses, names, things like that, just to make sure that there's no errors on there, because that can have an impact on or even cause delays if we have to get any extra paperwork to clarify anything. Now this sheet right here, I'll email this out to everybody, but this is the worksheet that I was talking about to determine your monthly survival number. So you put this all together, you just fill it all out, okay? And then you just times it by 6 and 12, and then that should be your goal to aim for, to save for the year. So try, or however long it's going to take you, but that should be the goal to save. About 6 to 12 months, and it'll be great. It'll give you a little cushion in the case of like any emergency, and also help you with this home buying journey. Let's talk about the loans. This is what we all here for. So loans. So here is the type of loans that really the basic loans that is offered out there. All right. What I like to explain to people when I explain like what I offer in terms of loans is that we all get our milk from the same cow. Okay, I know. My lady doesn't like that expression too much, but it's the truth, right? Wells Fargo, Bank of America, Chase, when they get the money to lend to us, they essentially go to Fannie Mae, Freddie Mac, FHA, VA, USDA to get that money and lend to us. Okay, so I do the same exact thing. There's no difference in terms of what I offer in terms of these products versus like a Wells Fargo, Bank of America. The only difference between myself and a big bank like and we are a big bank, we're actually the number one private mortgage lender in the nation, is that the main difference is that we just offer more products, right? Because we don't have that depository chain attached to us. We're not like a depository bank where we collect deposits and things like that and offer all types of other services. We just do mortgages. And so that gives us the ability and flexibility to offer a whole swath of products for just a whole myriad of situations and scenarios, okay? So, but this is the basics. Here is the basic loans that you will be offered if you were to walk into any bank. So you have your conventional loans, your FHA loans, your VA loans, and then your USDA loans. These are your government agency loans. Okay, so conventional, FHA, VA, and USDA. So the conventional loans, these offer the lowest down payment option. The minimum down payment for a conventional loan is 3%. Okay, so 3% of whatever that purchase price is, that's the minimum down payment, and then plus your closing costs and things like that. Okay, and then with, of course, with just 3%, mortgage insurance and all that, and we'll talk about that later. FHA, another great option. Minimum down payment is going to be 3.5%, and with FHA, the seller can contribute up to 6% of the sales price in the form of like a sell credit, so they can help pay for your closing cost. Okay, VAs, the VA loans are a great loan option for veterans. I love serving our veterans, and they offer 100% financing for our veterans. Okay, so for folks that have served in the military, I helped one of my family members purchase their home, and it's a great option for them, and so it's a great deal. And then USDA, these loans are for homes that you find in rural areas. So if you're in a rural area somewhere in America, these loans will actually also offer you 100% financing. Okay, and then there's like a census map, from the USDA that'll determine like what's the rural area that they'll cover. Okay, so those are the basic loans that you will come across. Okay, so now here are some other strategies that will benefit you in this whole journey. Okay, so when you're looking to buy a new home, the main challenge in today's America when it comes to buying a home is affordability. Is the monthly payment, interest rates. We just came from an environment where interest rates were at historical, unprecedented lows at 3%, in some cases 2.75%. Okay, and now just within the last 2 to 3 years, they jumped from 2 to 0.75% all the way up to 7% in some cases, 7.5%. So that really created a big market shock for folks and bumped a lot of people out of the home buying market. And so now people are just scratching their head as to how can I buy a house? How can I even afford this? Because maybe I do have the means to purchase, but I just don't want to deal with this like $5,000, $6,000, mortgage payment every single month. So what can we do? So there have some strategies in order to address the affordability issue, one of which is the buy down strategy. Okay, so the buy down strategy helps people ease in to that new mortgage at a lower start rate. So let's just say, for example, your interest rate or the going interest rate at the time that you purchased the home is at 7%. Let's just say. Okay, so at 7%, that is the going rate. That is what everybody in the market is offering. Wells Fargo, Chase, everybody, 7%. Okay, so let's just use the 2-1 buy down strategy for an example. So the 2-1 buy down, what this does is instead of you starting your mortgage journey off with a 7% interest rate, you would actually start it off with a 5% interest rate. Okay, so that would happen in year one. So in year one, you would start off with the interest rate of 5%. Year two, it'll go up to 6%. And then year three and on, it'll just revert back to what that market rate was when you first started and purchased the home at 7%. Okay, so that helps people, at least, get an interest rate below where market rates are at currently. It's not going to get you all the way down to the threes. It could, because right now interest rates are trading around 6.5 or so. So theoretically, if you were able to negotiate a 3-2-1 buy down, you can get your interest rate all the way down to 3.5% within the first year and start your interest rate journey off like that. So, I mean, there's still ways to get your interest rate to 3%. We just have to get creative and negotiate for it. But that's some ways that we still can get creative and help with affordability. So again, like we were just talking about, affordability and just hurdles that keep people from getting into homes. And affordability was one of them because of the huge influx in the interest rates over the last few years. Created a lot of market shock. Like all of a sudden, we're going from 2.75% all the way up to 7%. Then now the other big hurdle that I come across is the down payment and even the closing cost. Because sometimes folks will come to me, they'll be like, Mike, hey, look, I got the down payment. I was able to, pray and wrap my head around this whole monthly payment that you're trying to, give me. But I'm still coming short on these closing costs, right? Because that's everything that's required when you're purchasing a home, because you're going to have your down payment requirement, and then you're also going to have your closing costs. And so what are your closing costs? We'll go into more detail about that, but real quickly, it's things like your appraisal fees and your title and escrow, any prepaid interest, prepaid escrows, things like that. So all of that whole cumulative cost is your closing cost to close the transaction, right? So there's programs to help pay for your closing costs. So if you don't have, let's say you just have your down payment, but you don't have all of your closing costs, well, there's down payment assistance programs to help with that as well. Okay, so the one that we offer, and they offer them in every single state, every single city, where they'll give, up to sometimes 6.5%, sometimes even up to 20%, and there's different down payment assistance programs. It's important to read the details of these down payment assistance programs, because each and every down payment assistance program has a little different nuance or a little different caveat to it. For example, there was one in Napa County here that's being offered, and it just got brought to me from a client of mine who is just looking at down payment assistance programs, and they're offering 16.5% to help them with the purchase of the home. So that's huge. That's 16.5%, but the kicker is, and this is for Napa County. So for Napa County residents, the rule of that particular down payment assistance was you had to buy a house that was within 20 miles within your job. And then also they have what's called an equity share feature. Okay, an equity share feature within that loan. All right, so, and this is something that you want to just keep your eye open for that particular feature. And the thing is, it's like, it may be a good program for you, okay? But the one thing I just want folks to be oh, I just want folks to be aware. That's the main thing, and just understand what that means. Because the equity share feature, what that is essentially they'll give you 16.5% of the down payment closing costs. So it'll get you into the house. As long as you can qualify for the loan, you'll be able to get into the house. Now, the kicker is when you go to sell the house. So when you go to sell the house, any equity that you've accumulated as while you've owned the house, you have to pay that back to the county, which gave you and who administered the that loan program. So so if you borrow 16.5% of down payment assistance funds for that particular program using the equity share feature, when you go to, let's say, sell the property, you have to pay back that 16.5%, and then plus 16.5% of the appreciation value. So, for example, really quickly, and I'll move on from this, is that let's just say you have $100,000 house. You purchased it for 100. I'm just trying to keep the numbers simple because obviously we don't got no $100,000 houses in the Bay Area. But $100,000 for the home, and they gave you 16.5%. So they gave you $16,500 to purchase the house. So you're in the home. Okay. Now when you go to sell it, let's just say you sold it for $150,000. So in the regular world, you would just sell the home, $50,000 and net sale proceeds, and then minus all your commissions and fees and all that stuff. But $50,000 would be your profit, right? But in this case, you would have to pay back the 16.5% out of the $50,000 plus 16.5% of the $50,000 appreciation. So in total, out of the $50,000 that you would have profited, you're now paying. So yeah, you're paying about $33,500. So that's you're not really walking away with much equity in that scenario. So it can kind of hamper you in the event that you're trying to move up, and essentially you're trying to take that equity and move up into a bigger home. But again, I've gone probably a little too deep into that particular feature, but it's called a equity share feature. It's just something to take note of and keep an eye out for. But we do offer down payment assistance programs, and these programs, they do help. I've helped plenty of people get into homes using down payment assistance programs. They're very helpful. All right. So we talked a little bit already about how much cash that you're going to need in order to purchase a home, in terms of what the minimum down payments are going to be for each and one of these programs. Conventional, I mentioned 3% is your minimum down payment. For your FHA mortgages, your FHA, VA, USDA, it's going to be between 0 and 3.5%. And then for your jumbo loans, it's going to be 10%. Most places at your Wells Fargos, your Chases and things like that, they're going to require that you put between most likely 20% down for any jumbo loan. And jumbo loans are going to be loans that are above whatever the conforming loan limit is. And that conforming loan limit, that changes every single year, and it's dependent upon which county that you live in. So for myself, I live in Marin County, so we're considered a high cost area. Places like Alameda County, Contra Costa County, San Francisco, most of the Bay Area counties, Los Angeles County, these are considered high cost counties. So the conforming loan limit is going to be at $1.2 million. If funny or not, but it is $1.2 million, the conforming limit. So any loan amount above that 1.2 million, the minimum down payment now becomes 10%. Now, if it's at 1.2 million, the minimum down payment is 5%, which is pretty crazy to me, but 5% is going to be the minimum down payment in order to purchase. So yeah, theoretically, if you have a high, let's say, income job, and you have the cash, but you don't want to inject all your cash into your home, and you can afford the payment, yeah, you could go ahead and purchase a $1,000,000-some-odd home by putting just 5% down and getting into the home. Okay, but obviously you'll have a very big payment. Also, you can use gift funds A lot of first-time home buyers use gift funds to purchase a home. Gift funds from friends, from family members, and you can use those funds to help purchase a home. A lot of people that I deal with in terms of first-time home buyers, their parents or their family members help them out. So it's something that comes up a lot. That 726 200, that number needs to be changed. I'll update that next time. But the new conforming limits is about like $800,000 right now. And again, it does depend on which county that you're in. All right. So like we just went over, another cadet mortgage tip is when you are calculating your down payment, remember to include your closing costs. They can add up to thousands of dollars. Yes, they can. It's typically going to be between 2 to 5% of the purchase price of your home. So if your minimum down payment is 3% to buy a home and you're using conventional financing, I would budget another 2%. 5% is pretty expensive, but 2% is typically where I see closing costs to be. That'll be a safe number to budget. So in all, if you're using 3%, budget 5% total in terms of your total cash that you're going to need to purchase the home. These are your closing costs. Okay, so you have your home inspections, you have your appraisal, you have your homeowner's insurance, you have your attorney. This is for states that use attorneys to close real estate transactions. In California, we use a notary, but in other states like Missouri and things in the Rust Belt, they'll use attorneys. You'll have lender fees, you'll have your title and escrow fees, and then also you'll have transfer taxes. I would say Alameda has a pretty expensive transfer tax. They have probably one of the highest transfer taxes in the Bay Area. Also, Contra Costa has a pretty high transfer tax, but it just depends on which county that you're in. LA has a pretty high transfer tax as well. So these are just fees that are included in your closing cost. And then property taxes, depending on which month that we close your transaction in, will determine how much in property taxes that we'll collect, and then any prepaid interest. Okay, so these are all of your closing costs that are associated with purchasing a home. Okay, home inspections, very important. I highly recommend that if you are buying a home, get your home inspected. All right, this is a huge asset. All right, this is like a couple of, this is not a car. All right, it's not a car. It's couple $100,000, sometimes millions of dollars worth of in assets. You want to make sure you're buying a sound and worthy investment. Okay, and so you get an inspection. The inspector will go out there, and they are professional, they're licensed, inspect the home, inspect the structural integrity of the home, make sure your roof is good and all that stuff. So inspections, very important. The appraisal is going to be used in order to establish the value of the property, because the bank needs to have an established value to determine the loan amount, because there's certain ratios that the bank needs to stay within to issue the loans. And then there's lender fees. Really, the only lender fee I charge is going to be underwriting fee and processing fee, and that's it. That's your lender fee. That typically comes out to about $17.95. Okay. Then title and escrow fees. Your title and escrow is going to be title insurance, and then your escrow. So your title insurance is going to ensure that they're going to ensure that when they transfer ownership to you, that the person that is transferring the ownership was the rightful owner, and they had the right to transfer the ownership of that property to you. So that title insurance is something we pay for, and they will insure it and make sure that everything is all legit. And then the escrow. Who is escrow? Escrow is the middleman. They are the middleman in this whole transaction, because there's a lot of money being exchanged, and so you want to have a middleman to be able to just to facilitate how the monies is being moved around, and that way no one can accuse anyone of mishandling any funds and things of that nature. Okay, and then property taxes, again, like I mentioned, depending on the month, we'll collect how much property taxes is necessary to make your monthly tax installment, and then any prepaid interest. So when we issue out a mortgage, the mortgage is paid back in arrears. So meaning there's and I don't want to get too technical into that, but essentially it's just you have to. We're pretty much starting 1 month behind when we're paying a mortgage, and so we're just collecting that mortgage interest so we can make your so escrow can make that payment every single month. Okay. All right, so we are getting through it. We're pretty much halfway through this thing, so thank you so much. I see we have a question in there, and I will get to that question at the end. And so thank you so much, everyone. So let's talk a little bit about your income. So the income is a big piece, obviously, as to what the bank is looking at when they're qualifying you. So easy to remember is in terms of what the bank is looking at is they're looking at three main things, really. They're looking at your debt to income ratio, your credit, and your assets. Those are really the three main things that they're going to look at. So when it comes to your income, some of the things that they're looking at is like, do you have consistent income history? Like we talked about, we want to see 2 years of income history. Also, like if you well, another thing is that 2 years of income history, but we also want it to be stable. Okay, so what does stable mean? So stable means that if you are a dentist, we want to see that you've been a dentist for 2 years plus. But sometimes what happens is like, folks are like, well, I've been a dentist. I was a dentist for 1 year, but then I changed my mind and I want to become an auto mechanic. Well, that's not a consecutive, even though you've been working consecutively for 2 years, not within the same industry. So we do need to see 2 years within the same industry. So like if you went from being a dentist at one shop or practice within a year, and then you switched next year to another dentist practice, that's fine. That we can consider that to be a consecutive 2 years. Also, another quick tip for like people who are going to school professionally. Say that you are in school for nursing, for example, and you're trying to buy a home, and you just graduated from nursing school, and you now have a job within the industry that you went to school for. Well, we can count the time that you were in school as work history. As long as you are working within the industry that you went to school for, and you can show proof that you graduated, then yeah, we can use that. So theoretically, if you were going to school for 2-4 years, for nursing or whatever other professional schooling that you were going to school for, and literally the year that you graduate, if you have a job, literally if you have an offer letter, I could get you qualified just with that. You don't need the 2 years per se, of work history, as long as you've had that history within school. So so that's how they're gonna take a look at your income, the debt to income ratio. The way that works is real simple. All you have to do is just take your monthly debt obligations. So, and these are things that are going to show up on your credit report. So I'm not counting like your cable bill or your phone bill or things like that. These are credit obligations that show up on your credit report. So things like a car payment, any like credit card balances, any student loans, any personal loans, things like that were that are like an installment loan or some type of revolving line of credit. We're going to take the monthly payment obligation and then just divide that by your gross income. And then that is your debt to income ratio. So that's going to determine like how much of a house that you can buy. Real quick tip, keeping your debt to income ratio low will help ensure that you can afford your debt repayments. So the higher the debt to income ratio, the higher the debt is, obviously. And so we want to try to keep that low. This will give you peace of mind that comes from handling your finances responsibly, and it helps you be more likely to qualify for credit and for things that you really want in the future. So we will go over quickly what makes up your monthly payment. And so what makes up the monthly payment is going to be your principal, interest, taxes, and insurance. Principal, this is the portion that you're repaying every single month. Okay, so that is the actual loan amount that you're paying back every single month. The interest, that's the amount that's being charged by the lender. Okay, that's tax deductible. So you can take that amount, use that to reduce your taxable income. The taxes, that is going to be the amount that's charged from whatever city that you're living in. In California, when we qualify someone, we just take the rate of 1.25%. and we times that by the sales price, and then we'll just use that as your tax figure. And then homeowners insurance, which is a popular topic these days because no one likes to really insure homes in California these days. But still, there are places that will insure, places like the Fair Housing Plan. AAA has been a really good provider in providing homeowners insurance, but that's also something that will come into play in terms of your monthly housing payment. So principal, interest, taxes, insurance, we call that the PITI, so the PITI. All right, now additional costs that may come up depending on what your situation is going to be things like mortgage insurance. So in the event that you are putting less than 20% down on a home, you would have mortgage insurance. So what is mortgage insurance? Mortgage insurance provides absolutely no benefit to a homeowner. Okay, this is really to protect the bank in the event that a homeowner defaults on their loan. So if the homeowner defaults on the loan, then the lender gets paid, in full for the loan that they issued. This all came out of the 2008 financial debacle. So this was a way and a measure for banks to protect themselves if they are lending to people who can't repay the loan. Other costs that may pop up is mortgage insurance premium. So there is differences between all those like very basic loans that I went over, the conventional, FHA, VA, USDA. There's little nuances with each and every one of them. So FHA specifically, the main nuance with that is the upfront mortgage insurance premium, which we're highlighting right now. So as I mentioned, if you are putting less than 20% down, you're going to have mortgage insurance, and how the mortgage insurance cost or the rate is determined by your debt to income ratio, by your credit score, by how much money you're putting down, things like that. Now with FHA, it's just pretty much just a flat rate. So they're going to charge a 1.75% upfront mortgage insurance premium. That's going to be based off of the base loan amount. So 1.75% of whatever the base loan amount, and then they're going to take that figure and add it to the base loan amount. So that's going to be your total loan that you'll make a monthly payment on. Okay, and then on top of that, you'll have a monthly mortgage insurance premium as well. Now that's typically at 0.55% of whatever the loan amount is. And you cannot remove that mortgage insurance. That's on there for the life of the loan. Versus conventional, once your loan to value ratio, essentially once you get 20% of equity into the home using conventional financing, you can remove the mortgage insurance. Okay, but not with FHA. All right, but so you might be asking yourself, well, why would someone want to select FHA financing? Well, like I mentioned, the debt to income ratios for conventional financing, they max out at 50%. With FHA, they can go up to 55, sometimes even 56% for your debt to income ratio threshold. So they're a little bit more flexible in terms of qualifying. So they can actually help you qualify for a little bit more, or even just help you qualify if you have a little bit more debt on your books. So a little bit more of a flexible program helps people get into programs even with a lower credit score, and typically they have lower interest rates too. So that's that. So that's with the mortgage insurance, and then homeowner association dues. Okay, so for folks who are maybe looking to purchase a home in a condo or in a townhome, I live in a townhome community and we have a HOA fee every single month. So this isn't another cost to consider, or that may go into your monthly payment. So your homeowners association fee. So we'll go through the homebuyer roadmap, because this is now going to really drill into like what is really going to take, the game plan of actually putting everything that we've learned so far into action. Okay, because like I mentioned, the purpose of this is to arm you with what you need in order to walk out here with confidence, so you can start making the right moves to purchase your first home. Okay. So let's quickly just assess like who's on the team. All right, so who's going to be helping you through this whole transaction? This is your team that's going to be, and all the characters that are going to be playing a role in helping you purchase your new home. Okay, so you're going to have someone like myself, the loan officer. I'm going to be helping you figure out all your, numbers, running, loan scenarios for you and all that stuff, and issuing you out the loan. You're also going to have your real estate agent. They're going to help you find the homes, negotiate on your behalf, go over contracts with you, also go through inspection reports, and they should be an advocate for you, for you to purchase a home and getting a fair deal. Okay. The appraiser, that person is going to go out there, as we mentioned, to go establish the value of the property, and all that. The attorney, if you live in a state where that's applicable, they're going to help you with the signing of loan documents. Title company, they handle your title and escrow. We learned a little bit about that. And then the home inspector, we touched upon that, about the importance of making sure that you get a home inspection. And then a home insurance agent. So we spoke about homeowners insurance, and it is something that is going to be required, and you're going to need to insure your home. Okay, and there's going to be different types of requirements for different types of homes. For regular single-family homes, you just depending on which area that you live in, will determine if you need like flood insurance or hazard insurance and all types of stuff. So that'll get all detailed once you get in the journey. Okay. But the first step, like I mentioned before, is like when I meet people, people come to me at different stages in their journey. Some people are ready to go next month. Some people, it's going to take between 6 to 12 months for them to get ready. But regardless of where you're at, the first step is to meet with a lender. Okay. And I always say, like, there's many people who sit in my chair and do what I do. And you can work with anyone. I would really love for you to work with me, of course. But at the end of the day, like, what separates me from the next person is like the care, not really even the care, but like just how I manage the whole process. Okay, so because every lender is going to be a little different in terms of in terms of how they manage their process, how they manage their clients. And sometimes it just comes down to, do you like the person that is helping you in that chair? Are they communicating the information to you in a way that you feel palatable and that you can understand and that you connect with, and that varies from person to person. Because again, a lot of people do what I do, but a lot of people may not connect with those type of people. So there's certain people that just connect with me for whatever particular reason, But so meeting with the lender is, I would say, the first step. That's where you want to start. I know a lot of people, when they start this journey, they'll start on Zillow, on Redfin or something like that, and they'll start with the dream. And which is a great place to start. You start with the dream, and you start imagining, oh man, like, this is a beautiful home. I can see myself, working on my desk and projects here. I can see my kids, running in the backyard, and I can see myself putting up a new basketball court for my child and all that, in the swimming pool. That's where it starts, and then typically where it ends is like at my desk, because now it's like, all right, well, let's take the dream and let's manifest it. Let's put it together. So the first step, meet with a lender so we can put together a home buying game plan for you. Now, when you do meet with the lender, there's two things that you will, really there's one main thing that you want to get at the end of this lender, interaction, is a pre-approval letter. Okay, because the pre-approval letter is really what you're aiming for. That is what's going to activate your real estate agent to start looking for homes for you and to start actually submitting offers on your behalf, is the pre-approval letter. All right, now in order to get the pre-approval letter, you have to, of course, meet with the lender. And that lender needs to be able to take in all of your supporting financial documents, such as your pay stubs, your W-2s and bank statements, and if it's applicable, your tax returns, and verify that you have the ability to repay the loan that we're seeking, you have the assets to purchase the home, and then that you have everything that you need to make this transaction work. All right. Now, it's hard to believe that in this licensed professional industry is that you will come across people who will issue out a pre-approval letter that is not fully vetted. Yes, people will issue out a pre-approval letter that's not fully vetted. So I've come across this too many times to where I will get a new client, a realtor who trusts and has worked with me and our team. They'll come to me and they'll say, "Hey, Michael, I just don't, we're in escrow right now, and the lender said that they were approved, but now we're here, and they're not approved." It happens. It's happened more times than I would like to admit, but and that's due to and trust me, there's plenty of great lenders out there. All right, so it's only just a few that this happens to, unfortunately, but the what happens is that they just don't do their upfront due diligence. They don't verify the assets. They don't thoroughly verify the income, it's just not put together well. Okay, so you want to make sure that it's thoroughly put together. So there's really two differences between, or two things that you can get from speaking with a lender, which is a pre-qualification letter or a pre-approval. The pre-qualification is just when if you call me and we talk on the phone and you tell me that, hey, Michael, I make $120,000 a year. Last time I checked, my score was 780, and I got $120,000 to put down. Okay, great. Well, I'll do some tabling. I'll ask you, hey, do you have any debt? No. Okay, great. Well, hey, here's what you can qualify for. And then I can write you a pre-qualification letter based just off of that conversation, because this is what you're telling me, right? But I have not verified anything. I have not taken in any supporting documentation to verify what you're telling me. So a pre-qualification is all you would get. Now, when you're in the world of making offers and trying to compete with other home buyers, if you come with a pre-qualification letter, your offer is not going to come across as attractive as someone who comes with a pre-approval letter. Because someone who has a pre-approval letter, they've been vetted. They've had all of their assets and income and all that stuff verified, versus someone who hasn't submitted that documentation. Okay, so it's really however you want to roll. But a good lender and a good realtor is going to explain to you like what the advantages are, disadvantages are of having a pre-approval versus a pre-qualification letter. Really, some of the main benefits of having that pre-approval letter is it helps really determine your budget, because once we get you all pre-approved, then it'll give you an estimate as to like what your monthly payment is going to look like, and give you an estimate of what your cash to close is going to be, and that cash to close is going to be like your down payment plus all of your closing costs. And then also it'll get you better just buying power, because like I just mentioned, it'll make your offer stand out. When we're competing with other home buyers, depending on how they're structuring their offer, at least having a thoroughly pre-approved, scenario and an offer like a very fast closing is going to help you stand out. And then also, like I mentioned, it's going to help you avoid any setbacks and avoid any like big disappointments. Just imagine you getting into escrow. You've been working on this for so long. Okay, you've been getting all the paperwork, you've been following all the instructions that the lender has told you, and you finally find the house, you get the offer accepted, you get into escrow, you put your money in, and you're like, man, I'm cooking, everything is looking good. And then the lender comes back to you and says, yeah, sorry, bro, like you're not approved right now. That's devastating, man. That's absolutely devastating. Like, you had all of your hopes and dreams and everything already set on this house, and because of this person not thoroughly vetting you and getting you approved, it could really lead to that type of setback. It has happened. It is very, very disappointing. And then obviously this will save you time, so there's no surprises. That's one thing I just dislike the most, is surprises. I do not like surprises. I like things to be upfront. I like to work on everything and all the difficulties upfront, so there's no surprises when we go into escrow. It's typically just a smooth ride through. Okay, the documents that we're going to need to get this whole thing going is going to be 30 days of your pay stubs, the last 2 years of your tax returns, if you're a W-2 employee, and also the last 2 years of your W-2s. And then if you're like an independent contractor, or like you're a barber, or you do Uber, things like that, we'll just need the last 2 years of your 1099s. And then also 2 months of your bank statements, photo ID, and then we're going to do a credit check. But that's what's that's what's needed in order to kickstart this whole journey. Okay, so once we have all that, we vetted you, we've got everything put together, we'll issue you out that pre-approval letter. Then the next step is to meet with your agent, talk to them about what your wants, what your needs are, and then they're going to help you research homes within hopefully 3 to 6 months of when you intend to buy. And then again, like, what's the role of the agent? Because that's also come up as a pretty funny conversation out there in the internet streets, is that the agent's going to really help you be realistic about certain things. Be realistic about your budget, the area that you're looking to purchase into. Look at certain demographic information like your neighborhood crime rates, the quality of the schools, transportation. Quality, also look at the home in terms of if there's any like structural issues, cosmetic things that they feel that you should be able to negotiate for. That's going to be the role of your real estate agent. Okay. And then once you guys go through all that whole consultation, they're going to help you put together an offer. All right. So once you found that home, your agent's going to go ahead and negotiate the price for you, help you schedule the home inspections, and then get that whole show going. Also on the back end, they're doing a lot of research in terms of like the neighborhoods, in the form of like what's sold and what are the trends in that neighborhood looking like in terms of pricing, crime, schools, and all these things, which are important things to consider when you're purchasing a home. All right, because you want to make sure that you're making a wise investment. You want to make sure that if you have children, that the school systems are adequate for you and all that stuff. So this is all of the things that the agent is working on your behalf in the background, so you don't have to go out there and try to piece all this stuff together. Here's some of the do's and the don'ts while you're going through that whole process, and some of the do's. Definitely inform us if you are going to be changing jobs. So you don't want to quit your job like the day before we're going to close, or be like, well, as soon as I get the loan, I'm going to make sure you let us know so we can advise appropriately, and all that. Also, let us know. Definitely do let us know if there's any changes in your pay, specifically if you get like a pay raise, because when you get a pay raise, we'll actually be able to increase your pre-approval amount. So that definitely helps. Definitely do continue to pay like all of your debt obligations. If you have rent, if you have a mortgage, continue to make all of those payments on time, credit card payments and all that stuff. Also do keep a paper trail of any movement of money that goes between accounts, because we will need to document like any significant movement of just monies that are going through accounts. Okay, so something to keep in mind. Of course, notify us of any like significant changes in your finances, and also tell us if you have any travel plans through the escrow process, because in the event that we need to arrange for signing and all that other stuff is something that we definitely want to be aware of. Definitely don't quit your job. Like I said, don't co-sign for anyone. That'll hurt your debt to income ratio. Don't transition from being a W-2 employee to being self-employed. Don't apply for, try not to apply for new credit cards, and don't close out old credit cards. Because again, we need to have established trade lines to determine that you have credit history. So, so don't do that. Try not to max out any credit cards like we've talked about. We talked about the utilization rates that we want to see you at. So if you have a $1,000 credit card, try to keep that balance at $300 or less. And then try not to move around a lot of funds, because every time you move funds around, we need to show a paper trail of those funds. So we'll need to get literally printouts of the statement to show money went from account A to account B, then from account B to, to escrow. So it's like the less you move the money around, the better. All right. So real quick, who makes the final decision on your loan? Michael Cadet does not. Michael Cadet does not make the final decision on your loan. The person who makes the final decision on your loan is going to be the underwriter, okay? So the underwriter, they make the final decision on your loan. Imagine the underwriter as the judge, all right? And I'm like your lawyer. So I represent you. I collect all of your supporting, documents, all your supporting evidence to support the fact that you have the ability to repay this loan. And the underwriter is going to be the judge. All right, so we're going to collect that file, submit it off to underwriting, and then they're going to take a look at everything. They're going to take a look at like your income. They're going to take a look at the contract, the house, the appraisal, the whole package, the whole shebang. They're going to take a look at, and then they're going to come back with us with a decision within 48 hours or less, and let us know, hey, you have what's called the clear to close, essentially the final approval. And that's what we're looking for. We're looking for our clear to close. That is the green light to give us the okay to go ahead and fund the loan, close the loan, and do all that good stuff. And then after that, after we get our clear to close, then loan documents will get sent to escrow so we can set up your signing. Then once you sign, then those signed documents will come back to our office to prepare for funding. And then funding will go out, and then you'll close, and then you'll have your new home. Cost and stuff like that, we can quickly go over like the origination fee. This is a fee that's paid to the lender, but we do not charge an origination fee. But in the case you're shopping out there, hope you're not, but if you are, that is a cost that you should be aware of. Title insurance fees, prepaids. This covers the mortgage interest between your closing date and first mortgage payment, escrow fees, appraisal fees, transfer and recording fees. And points. So points, that's an important one. So you have the ability, let's say, you have the ability to buy down your interest rate. Okay, so let's say like the going rate, like in terms of what most people are getting, like let's say it's 6.5%, right? That's like the going rate. Most people are closing their loan with a 6.5% interest rate. Well, if you want, you can buy down your interest rate further. So if it's worth it to you, and we'll do a quick calculation to see if it's worth it to you, if you wanted your rate in order, lower in order to achieve a monthly payment goal that you had in mind, then you can reduce that monthly interest rate down to, let's say, 6.25%. Then the question just comes to, what's the cost to lower the rate that far, and if it's worth it, and if the savings. If you can recoup the savings within 36 months, then I would say it's worthwhile. But if not, then something to consider. So those are mainly all of your fees right there. So and I'm going to send you guys a copy of all of that. But again, this is that concludes our workshop today. And again, this is really the tools that you're going to need in order to take that first step to home ownership. And if you do want to take that first step, all you need to do is, when I send out the thank you email, is respond with the time that you would like to connect, and we can take that first step just to start putting together a game plan for you, because that's really where it all starts, is the discovery call. So the discovery call, it's held with myself, and typically we just spend 15 to 20 minutes just speaking about your goals, where you are financially, and then putting together a game plan for you to purchase a home. So as soon as we get out of here, I will send out that email, and all you have to do is just respond with saying yes, and then just schedule it on the calendar, and then we'll get you on a discovery call to take that first step.